stock turnover rate. Turnover rate. And what is this formula made up of? This formula is made up of cost of sales all over average. I'm going to put a color so you don't use normal inventory. Use your average inventory. Okay? Again, what does average imply? Inventory. Again, what does average imply? Average implies last year, for instance, and this year. So the sum of these two all over 2 to get your average. Okay? And your answer is going to be so many times a year. Because your cost of sales in your income statement is a yearly amount, as well as your inventory in your statement of financial position is also a yearly amount. So your asset is a yearly amount. Okay, so and that's why it's going to be times, how many times a year? Okay, what else can we deduce from this formula? So you want the answer to be as high as possible. And why do you want it to be as high as possible? Of course, it depends on the industry you are in. So if, for example, you sell stuff that perish, so it's how many times a year your stock is replaced or finishes, runs out, basically. Okay, so it depends on your industry. So let's go into it. What do we mean it depends on your industry? If you're selling tin food, you could sell things 4 times a year, because we are saying tin food is a non-perishable item. So it doesn't need to be sold in high quantity versus something like bread, right? Which will be sold maybe 360, your stock will be finished 365 times in a year, because bread is a perishable item. You expect to sell it quicker and more often. And again, you get your things that are less sold, such as your luxury. And maybe you could say, for example, twice a year. And this could be your luxury vehicles, such as your Bentleys. These you'd probably only sell like a few in a year. You're not going to sell a lot. So we're saying, how many times a year would your stock be